The behavioral gap. Why smart people make terrible investment decisions. There's a gap in investing that nobody talks about enough. It's not the gap between good funds and bad funds. It's not the gap between active and passive management. It's the gap between the return an investment generates and the return the investor actually receives. Research by financial firm Dalbar has tracked this gap for decades. The average equity fund returns around 10% per year over long periods. The average equity fund investor receives around 6%. That missing 4% isn't taken by fees. It isn't lost to bad fund selection. It disappears because of behavior, because of the decisions investors make about when to buy and when to sell. Why intelligent people make terrible investment decisions. Investing is one of the few areas where intelligence can actively work against you. In most domains, more thinking leads to better outcomes. In investing, more thinking often leads to more intervention, and more intervention almost always leads to worse results. The investor who checks their portfolio daily and acts on what they see will almost always underperform the investor who checks quarterly and does nothing. Not because the daily checker is less intelligent, because they're more responsive to information that, in the short term, is mostly noise. The market generates a constant stream of signals: earnings reports, economic data, geopolitical events, analyst upgrades and downgrades, central bank decisions. Every single one of these feels important and actionable in the moment. Almost none of them are relevant to a long-term investment thesis. The investor who responds to each one is not managing risk. They're generating transaction costs, tax events, and timing errors that compound against them over years. The three behavioral errors that destroy returns. The first is recency bias. Whatever happened recently feels like what will happen next. After 3 years of strong returns, investors pour money in at the top. After a crash, they pull money out at the bottom. They're systematically buying high and selling low, driven entirely by the extrapolation of recent experience. The data on this is damning. Fund inflows peak near market tops. Fund outflows peak near market bottoms. The average investor consistently does the opposite of what generates returns. The second is overconfidence. Most investors believe they have information or insight that justifies their conviction about individual stocks or market timing. The research is clear. Most active traders underperform passive indexes after costs and taxes. The subset who outperform in one period are no more likely to outperform in the next than chance would predict. But confidence doesn't require evidence. It requires a story, and the market always provides one. The third is loss aversion in action. Losses are psychologically twice as painful as equivalent gains are pleasurable, so investors hold losing positions far too long, hoping to break even, and sell winning positions far too early, locking in gains before they can disappear. This behavior, called the disposition effect, systematically generates worse tax outcomes and worse returns simultaneously. The solution isn't more discipline, it's less decision-making. The counterintuitive answer to behavioral bias isn't to try harder to overcome it, it's to remove the opportunity to act on it. Automate your investments so contributions happen regardless of what the market is doing. Set a target allocation and rebalance on a schedule, not in response to market movements. Stop checking your portfolio daily. The less frequently you look, the less frequently you'll feel the urge to intervene. The less you intervene, the closer your actual returns will be to the market's returns. Warren Buffett's most quoted investment advice isn't about stock selection, it's about temperament. The ability to sit still when everything around you is moving is the rarest and most valuable skill in investing. It's also the least taught, because it can't be sold as a course, a product, or a strategy. It's just the discipline to do less, more consistently, over a longer period of time than most people can manage. The practical framework. Define your investment policy before markets move. Write down your target allocation, your rebalancing rules, and your investment thesis, why you're invested in what you're invested in. Then commit to reviewing it once or twice a year, not once or twice a day. When markets drop and the urge to sell becomes overwhelming, read what you wrote when you were calm. The best investment decisions are made when markets are quiet. The worst are made when they're loudest.